In 2023, my investing strategy is not changing whatsoever. I'll be focusing on buying quality businesses that grow their dividends over time at good valuations, which will help me achieve my long-term goal of one day being able to live off of dividend income. In this video, I'll be revealing 3 companies that I believe are trading at a good value. 2 of these companies I just recently added to my portfolio, and the other one has long been one of my favorite investments. If you'd like to be able to download the spreadsheet used to analyze these companies, then you can head over to my Patreon page at the link in the description. My first dividend pick of 2023 is Broadcom, stock ticker AVGO, currently trading at $583.98 per share. This is actually one of the companies that I just recently added to my portfolio. I bought 3 shares, and right here on my do-it-yourself investor toolkit, you can see I'm actually already up over 12% on this position. Now, if we jump back over to Seeking Alpha, we can see over the past year, they're down about 8.3%. But if you look at how other chip makers have performed over that time, they have way outperformed the market. And it's also provided opportunities to buy in at great prices, as we can see right here. Now, if we look at the dividend history for this company, let's go ahead and jump out and look at 10 years. They have seen some of the most amazing dividend growth that I've seen out of any of the positions in my portfolio. If we look where they were back about a decade ago, they were paying out 19 cents a share quarterly. Jump forward to now, and that is now $4.60 every single quarter. That is absolutely unbelievable dividend growth. Now, like any company that we're going to be looking at, there's obviously some risk, but really I think the largest risk for Broadcom is the greater macroeconomic risk. Obviously, there is a threat of a looming recession. So if that were to happen, I think we could definitely see this company drop lower. But with that being said, let's go ahead and jump into my valuation spreadsheet to see if we can find the intrinsic value of this company. And like always, we're going to be looking at a few different valuation models for this company. But let's go ahead and jump back over to our stock screener. Like always, depending on what you plug in right here, you can automatically pull in all of that data. So let's go ahead and plug in AVGO and hit enter, and you can see all of this data will load in. We're currently looking at a 500-day change. So from its all-time high, you can see it's still down quite a bit despite the recent bounce back. Come over here, we can see they currently have a dividend yield of about 3.16%. So that's a pretty good starting dividend yield. Payout ratio is pretty close to 60%. So I typically like to see it just a little bit lower, but it's not necessarily a red flag. If we come down here, we can see analysts currently have a target price of $646 per share. Institutional ownership pretty decent at about 80.7%, and the beta is sitting at 1.07, so you will see a little more volatility than normal. But let's go ahead and jump into our first valuation, and that's going to be Graham's valuation. And we can see the formula he lays out for us to calculate intrinsic value right here. So we plug in our earnings per share right here. We apply our growth rate projection. I'm staying pretty close to what analysts are projecting for this company. We then multiply that by the average yield of AAA corporate bonds and plug in the current yield on AAA corporate bonds. And at the time of this video, that is sitting at 4.5. So when we plug all this in, we come to an intrinsic value of $570.69 per share, which is actually really close to the current trading price for the company. Now, because of the macroeconomic conditions, the current yield on AAA corporate bonds is sitting at a pretty high number, and that is going to drive this valuation down quite a bit. Let's say this number were to be 3, which is around where it was about a year ago. You can see just how much the intrinsic value for this company would jump up. Let's go ahead and jump over and now look at our discounted cash flow model. And to do this, you can see I plugged in the historical free cash flow for this company so we can see our year-over-year growth rates. And just like their dividend growth, their free cash flow growth has been absolutely unbelievable, which is necessary if they are going to be able to maintain that high dividend growth rate. So moving forward, I'm projecting an 11.5% free cash flow growth rate to the future free cash flows of the company and to the terminal value. I then found the present value of those future free cash flows and added them together here, added the company's cash and cash equivalents, and subtracted out the total debt to get their equity value. I then divided by the shares outstanding to get a discounted cash flow price per share of $847.92 per share. Now let's go ahead and jump over to our multiples valuation, and this is a pretty important valuation model because it's going to allow us to see how the market is valuing companies that are similar in structure. So you can see the comparable companies I'm using right here. We're taking their stock price, dividing by the earnings per share to get their price to earnings multiple. We then take the average price to earnings multiple of these companies, multiply by AVGO's earnings per share to get an intrinsic value of $476.41. So that is a bit below their current trading price. So what exactly does that mean? Well, if we look at the average price to earnings for these comparable companies, around 17.9. If we jump back over to our stock screener, we can see the price to earnings for AVGO is currently sitting at 22.8. 0.01. So it is clear they're trading at a premium, but is that fair? I think that's something you have to decide for yourself by looking at the free cash flow model and looking at the growth rates, and also looking at our last valuation model, which is going to be the dividend discount model. And the idea behind this valuation is we should be able to value a company based on how much it pays out in dividends and how much that dividend is growing over time. So you can see I plugged in the quarterly dividend payouts here so we can see how much the company is paying out each year. And this allows us to see our year-over-year growth rates: 22.6 really good, 10.77, 13.9, and 12.2. So very good dividend growth, as we've already seen over the past few years. If we go back even further, we've already seen that it's really good back then too. But that's an average growth rate of about 14.9%. Now moving forward, I'm projecting a growth rate of 6.75% and a discount rate of 9%, which gives us a dividend discount model price per share of $872.98 per share. So based off of our discounted cash flow and our dividend discount model, I would actually say that it's fair that this company does trade a little bit at a premium and has a higher price to earnings than these other companies. But let's go ahead and jump over to our output tab. And here we can see all four of our valuations. We have Grams at 570, multiples at 476, discounted cash flow at 847, and dividend discount model at 872. And when we average all four of these together, we come to an intrinsic value of $692 per share even. Now the current trading price for this company is about $584 per share, but we are value dividend investors. So let's say we want to apply a 10% margin of safety. We can see based upon that, our acceptable buy price for this company is around $622.80 per share, meaning now may be a good time to consider buying. If you were to apply a 20% margin of safety, you can see your acceptable buy price would be about $553 per share, meaning it's not quite in that buy range, but it is getting pretty close. Now, if we jump back over to Seeking Alpha, we can see trading at the $553 range is very possible. It wasn't so long ago when it was in that range, and it did trade as low as we can see right here as $415.07 over the past year. So there's definitely opportunities with this company. My second dividend pick for 2023 is Jefferies Financial Group, stock ticker JEF, currently trading at $37.79 per share. Now this is a company that was actually recently added to the portfolio of Berkshire Hathaway, and anytime that happens, you can see some pretty good short-term performance. If we look at the past 6 months, we can see this is actually a stock that's up about 36.29%, but despite this, over the past year, they are still down about 6%. Now, this is actually a holding that I already added to my portfolio as well. I'm currently up about 10% on this position, as you can see right here. But let's go ahead and jump into my valuation spreadsheet. The way we value this company is going to be a little bit different because this is a financial stock. But let's go ahead and plug in the stock ticker JEF and hit enter, and you can see again this data will load in. Their current dividend yield at their share price is still over 3%, so that's a pretty good starting dividend yield. Really nice low starting payout ratio at 28.4%. Analysts currently have a target price of about $38.50, pretty close to that current trading price. Institutional ownership is actually not that high at about 66.1%, and they have a pretty large beta at 1.39, so be wary, you will see a little bit of volatility with this company. But let's go ahead and zoom in, and we'll start with Graham's valuation like always. Again, we're going to plug in these variables like our earnings per share, our growth rate projection, and the current yield on AAA corporate bonds. And once we've done all of this, we come to an intrinsic value of $61.34 per share. That is quite a bit higher than that current trading price. Now, the next thing I typically like to look at with financial stocks is the historical price to tangible book value. So let's go ahead and zoom out. And essentially what I've done is I plugged in the share price over the past decade and the tangible book value per share over the past decade. And we also have the current data right here. So we have the past decade charted out. So we can see typically they trade above 2 for their price to tangible book value, but they're currently trading at 1.03. That's a huge indicator that they may still be undervalued. And I think that's one of the reasons that Berkshire Hathaway probably added it to their portfolio, because I know this is something they look at really closely when they look at bank style stocks or financial stocks. Now, the next valuation we want to look at again will be the multiples valuation. You saw this one earlier, and you can see the comparable companies we're using right here, taking their stock price, dividing by the earnings per share to get that price to earnings multiple. We take the average price to earnings multiple, which is about 10.8, multiply it by JEF's earnings per share at 3.69, and we come to an intrinsic value pretty close to their current trading price, as we can see right there. Now, with a financial stock, anytime I look at the multiples valuation, I also want to look at the ROA for each of these companies. And something you will notice is that JEF actually has a quite a bit higher ROA than these comparable companies, which to me, I think it means you could argue that they should be trading at a premium when it comes to their price to earnings. And the average price to earnings for these companies, again, 10.8. But when we jump over to the stock screener, we can see JEF pretty close to that price to earnings. So I would argue that they should be trading at a higher value than these companies. Now, the last thing I do want to look at is going to be our dividend discount model. Again, you can see our year-over-year dividend growth right here. They've seen unbelievable dividend growth just like AVGO. That's an average growth rate of almost 25% over the past few years. Moving forward, I'm projecting a growth rate of 6%, discount rate of 8.5, which leads to a dividend discount model price per share of 50.88. So when we jump over to our output tab, we can see 3 different valuations and our current price to tangible book value. I didn't use assets under management because I couldn't find a reliable data on that. But even with all of this data, you can see I came to an intrinsic value of $50.73. Also, again, we have to mention that current price to tangible book value looking like it's trading way below value. So let's say we apply a 15% margin of safety for an example. Based upon this, our acceptable buy price for this company is about $43.12 per share, meaning now may be a good time considering adding to your portfolio. Now, keep in mind, as with any investment, it can take a while for a company to reflect its true intrinsic value. I think that will likely be the case. Anytime you see Berkshire Hathaway invest in a company, they are investing for a long time period. So I think over a long time, this will perform very well. I don't know if you'll see good short-term performance, but as for me, I will definitely consider adding more to my portfolio. And my last dividend pick for 2023 is Microsoft, stock ticker MSFT. If you've watched the channel before, you know this is a company I talk about a lot because I believe it's going to be one of the best long-term investments for value dividend investors because you're going to see so much dividend growth over time. And we can see it's currently trading at $222.97 per share. And over the past year, it's down nearly 30%. Now, again, like any investment, I think there's still macroeconomic headwinds that may happen that could cause the stock price to go lower. But let's go ahead and jump into our valuation spreadsheet. We'll come over here and plug in the stock ticker and hit enter. We're currentently looking at a 1,000-day change, so you can see there was a huge run up in the share price, but since then it's dropped down quite a bit. If we come over here, we can see they're paying out $2.72 per share, which gives them a starting dividend yield of about 1.22 and a really nice payout ratio at 26.6. Analysts currently have a target price of $296 per share. Institutional ownership is sitting at 72.4 and a beta of 0.94. So let's go ahead and jump into Graham's valuation and we'll zoom in here. And we can see when we plug in these variables like our earnings per share, our growth rate projection, and current yield on AAA corporate bonds, we come to an intrinsic value of $213 per share, pretty close to the current trading price, but slightly below it. Again, that current yield on AAA corporate bonds is really going to be driving down this valuation in this scenario. If it were to be closer to 3 like it was about a year ago, you can see the intrinsic value would jump up quite a bit. Now let's go ahead and move on to our discounted cash flow analysis. And if you look at analyst projections for free cash flow growth, you're going to see growth rates of around 15, 16, or even 17%. I'm going to stick with that and go with a 15% growth rate to the future free cash flows of the company. So once I plug in the cash and subtract out the total debt and divide by shares outstanding, you can see we come to a discounted cash flow price per share of $314.20. Now, this is actually going to be a scenario where I don't use the multiples valuation. There's a few different reasons, and I'm not going to dive too much into the details, but basically I don't think there's very fair valuations due to the current market. But let's go ahead and jump into our dividend discount model. And again, I plug in the quarterly dividend payout so I can see how much they pay out each year. And we can see our year-over-year dividend growth is really good for this company at 9.5, 10.8, 9.8, and 10.71. So for a company as old as Microsoft to still grow this much and grow their dividends this much over time, I think that's a really encouraging sign. Moving forward, I'm projecting a growth rate of 8.25, a discount rate of 9, and we come to a dividend discount model price per share of almost $358. So when we jump over to our output tab, we'll see our 3 valuations. Graham's at $213, discounted cash flow at $314, and dividend discount model at $357. And when we average those 3 together, we come to an intrinsic value of $295, which if you remember, we jump over to our stock screener, we can see it's actually really close to what analysts' current target price is for this company. Let's go ahead and add a 20% margin of safety, and based upon that, you can see our acceptable buy price is $236 per share, meaning it is within that buy range. So if you don't currently own this stock in your portfolio, I think you should at least consider adding it to your watch list. It does have a low starting dividend yield like we saw just a few moments ago, so if you have a shorter time horizon, I could understand why you don't invest in the company, but if you have a long investing time horizon, this is definitely a company you want to consider adding to your portfolio. So there you go, those are my top 3 dividend stocks for 2023. I don't know how well they'll do in the short term, but I definitely believe in these companies long term, and I think they'll help me achieve my long-term goal of one day being able to live off of dividend income. If you'd like to be able to download these spreadsheets, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.